Okay, so we're in the last section of our chapter, 19.3, and we're going to be estimating inventory. So estimating inventory by using the previous year's percentage of gross profits on operations is called gross profit method of estimating inventory. And that method is often used to estimate the cost of the ending inventory reported on monthly financial statements. The gross profit method is a less expensive method of calculating inventory costs than taking a periodic inventory or maintaining a perpetual inventory system. So the gross profit method of estimating inventory. All right, so step one, you're going to get your beginning inventory for January 1 plus your net purchases for January 1 through January 31st. And that's going to equal your cost of merchandise available for sale. And I've lost my cursor. There it is. Step 2, your net sales for January 1st through the 31st. So your net sales were $99,340, and you're going to multiply that times the previous year's gross profit percentage of 40%. And that's going to give you your estimated gross profit on operations. Then step 3, your net sales, which were $99,340, less your $39,736. So you're going to take your net sales minus your estimated gross profit on operations. Whoops. And then that's going to equal your estimated cost of merchandise sold, your $59,604. Step 4, cost of merchandise available for sale. So that's your first number, okay? That's your cost of merchandise that you have available to sell. And then you're going to minus out your estimated cost of merchandise sold. And that equals your estimated ending merchandise inventory. And then you take that, you subtract from that your merchandise sold, and it equals the estimated ending merchandise inventory. So when the gross profit method of estimating inventory is used for months other than just the first month of the fiscal period, the process is the same as that just illustrated, okay? So net sales and purchase amounts are obtained from the general ledger. For the sales account, the previous month's ending balance is subtracted from the current month's ending balance to calculate the amount of sales for just the current month. But that same process is used for purchases account, okay? So this estimated ending merchandise inventory is what goes in your income statement right here. Let's walk through this 19.3 work together, and maybe that will kind of clear things up if you have any questions. But I want to point out before we do that the gross margin calculation illustration right here that I've shown, here in this slideshow was just for the first month of the fiscal year. Okay, so this is just for January. So I just want to make sure and point that out. And the income statement that we have here is just for January. And this is the same steps. These steps that you took here are the same steps that you'll do for the month of February, the month of March, and so on. Okay, so let's go ahead and go to APLIA. And you guys should open chapter 19.3, work together. And we're just going to do the steps that it takes to fill out our income statement. Okay, so here are our instructions. These can also be found on page 576 of your textbook. And we're just going to plug in the numbers, okay? So, let's see. Sorry. All right, so we have here, and I'm going to have to get off this, so you might open up your own textbook page again, 576, or print those instructions off and have those by your side while we're doing this work together. I'm just getting my textbook situated so I can see. All right, so first of all, our estimated beginning inventory on June 1st is given to us, and that is for $154,800. This is given to us, okay, in the instructions. I'm just going to show right here. Then we've got our net purchases for June 1st through June 30th. Again, this is given to us, $47,800. And that's going to equal the cost of merchandise available to sell. So if we add this up, 154,800. Oops, we want to add, 47,800. And you're going to get $202,600. Okay, so that's step one. Now step two, the net sales for June 1st through June 30th. And it tells us here that our actual sales for June were $245,000. So let's go ahead and put that number here. And then we want to multiply that times our previous year's profit percentage. Again, this number is given to us. Our estimated gross profit percentage is 45%. So right here, we're going to put 45%. Trying to figure out how to put this in a plie. Nope, that won't work. Okay, so we need to just put the number 45 because it's 45%. Okay. So we multiply this times 45% to get our estimated gross profit on operations. So again, let's go to our calculator. And we have 245. And we're going to multiply that times 45%. And we get $110,250. Okay, that was step two. Now step three. It says our net sales for June 1st through June 30th. And we already know that. That's this number here. So that's 245. Minus our estimated gross profit on operations, which is this right here. So our 110, 250. And so let's subtract that out. Minus, 245 minus 110,250. And so we get 134,750. All right, let me pull this up for you. Now step four is going to ask for our cost of merchandise available for sale. And that is up here, cost of merchandise available for sale. So that's 202,600 minus our estimated cost of merchandise sold, which we can find right here. So that's 134,750. And then if we subtract that, we're going to have 202 minus 134,750. And that's going to give our estimated ending merchandise inventory of 67,850. Okay, so these are the steps that we needed to do our income statement. So we're going to go down to our income statement now, and you'll see, let me just go back up here. Use the following information obtained from the records and management of Evans Company to estimate the cost of ending inventory on June 30th. So we went through all the steps, okay, to estimate the ending merchandise inventory right here. Now step 2 says prepare an income statement for the month ending June 30th of the current year. Okay, so that's what we're doing with these numbers here. All right, so our net sales were $245,000. Okay, net sales for June 1st through June 30th are $245,000. So we're going to put that here, and that's 100% of our sales. That's all our sales. Okay, now we're going to go for our cost of merchandise sold. So the estimated beginning inventory June 1st was $154,800. So that amount's going to go here. Then our net purchases were $47,800. So we're going to put that number here. That's my phone going off. Okay, so then our merchandise available for sale. Again, we're going to get all this information from the steps we took up here. So our cost of merchandise available to sell is $202,600. Now we're going to do less the estimated ending inventory on June 30th. So estimated ending merchandise inventory was $67,850. Okay, so now our cost of merchandise sold. Okay, cost of merchandise sold. The estimated cost of merchandise sold is right here. So that's $134,750. And remember, if we divide this number by this number, let's go do that. 134,750 divided by 245,000. That's going to give us 55%. So 55% of our sales are right here. All right, now our gross profit on operations. That's just going to be our 245 minus our 134,750. That's not right. 134,750, and that's going to give you your gross profit on operations. Okay, gross profit is your net sales minus the cost of merchandise sold, and that amount is $110,250. Now, if we divide this number by this number, we should get 45% because 45 plus 55 equals 100. But I'm going to go ahead and do it just to make sure. So we have 110,250 divided by 245,000, and that equals 45%. So we're going to put that right here. So remember, these two numbers, your cost of merchandise sold and your gross profit on operations, have to equal your 100% of net sales. So if these don't equal, you know something's wrong. Okay, you've either miscalculated or done something wrong. Okay, so our operating expenses. Okay, so I had to pause the video so I could answer a phone call. And I started doing the problems without you guys, so I apologize. So I think we left off, we got our operating expenses of $76,930. We got that from our instructions. Actual operating expenses for June, $76,930. And then we subtracted $110,250 minus $76,930, and we got this $33,329, which was our net income. Now to get our percentages over here, and I'm just going to go ahead and do this so that you guys are seeing this. We're going to take $76,930, and we're going to divide that by our net sales. Okay, so our $245,000. And we're going to get 31.4%, because remember, you moved the decimal over twice. So I just put 31.4 here. Same thing, we're going to divide 33,329. We're going to divide that by our net sales up here, the 245. And that's going to equal 13.6. Okay, we just move that decimal over twice. If this were a 5 or higher, this would turn into a 7, but it's not, so it's 13.6. Put that amount right here. And then you are finished. Now, to double check your numbers, these two numbers right here, 31.4 and 13.6, should always equal your gross profit on operations. So if we added that up, just to show you, 13.6 plus 31.4, it's going to equal our 45% right here, gross profit on operations. Okay, so your assignment now is to do 19.3 on your own and the application problem.